If you are selling the real estate in a sale-leaseback transaction today, you have the immediate access to that capital to be able to reinvest it into that business. Maybe it's growing and buying another point nearby, or maybe it's reinvesting that capital back into the business and seeing an improvement in performance in the short term, right? So then when you go and you're selling the enterprise later on, assuming there's improved performance there, the blue sky multiple on a greater figure is going to yield a greater proceeds figure.
Today, I'm excited to speak with Mark Pomella, Vice President at SAB Capital, a commercial real estate firm specializing in sale-leasebacks of car dealerships. We discussed a massive $30 billion market hiding under car lots, along with dealership real estate tax hacks, and much more.
A big thank you to our sponsors for making today's episode possible. OpenLane, Cars Commerce.
Mark Pomella on the CDG podcast. Mark, welcome.
Yossi, it is an absolute pleasure to be on the show. Thank you for having me. I'm excited to talk about sale-leaseback with your network, and I'm really looking forward to the conversation. So let's have some fun.
Pumped to chat real estate valuations. We are, typically our episodes that are very highly anticipated dive into some esoteric part of the dealership that maybe people don't know so much about, whether it be how reinsurance really works, ancillary products, or in this case, real estate, valuations, sale-leasebacks, kind of state of the market. So I'm pumped to talk about that and really, offer that insight to our listeners. So I want to hop right in. Before we get into specifics of dealership real estate, can you give us a very short, brief overview of the state of the real estate market today?
Happy to do that. So I think, when you look at the real estate market as a whole, specifically commercial real estate and net lease and sale leasebacks, right? It's not dissimilar to, the car dealership industry where, there's massive impact from COVID and, there's effectively before and after the pandemic. In the way that the market is working is entirely different in the fallout from that. So, it's probably worth taking a walk back to, this period of 2021 to 2022, which is between the outbreak of COVID-19 and the beginning of the Fed rate tightening cycle. This was a great period of time because money was cheap and valuations were high, both as a result of cap rate compression and several years of market rent growth. So at that point in time, the average cap rate for sub-investment grade credit tenancy, which is the bucket that most car dealers are typically going to fall under, which is your middle market companies of sizable revenue and earnings, and that comes down a little bit. That average cap rate heading into 2022, even towards sub 6% on average. Then in March of 2022. When the Fed starts its tightening cycle and cost of capital for sale-leaseback sponsors increases, the transaction velocity in the market, as you compare 21 and 22 to 23 in the first part of 2024, is of lesser scale. Depending on geography, lease, and credit composition, cap rate yields today are somewhere in the range of 100 basis points higher on average. If not, closer to 125, 150 basis points higher than that low point.
So let's summarize that for a second. You're saying that today cap rates on dealership properties, or are you saying all commercial real estate?
Across the board, and it's directly related to the cost of capital for some of these real estate investors financing their acquisitions.
Yeah. So I have a bunch of questions on valuations and specifically dealership real estate. Before we get into that, I just want to table set. What do you do? Can you explain to the audience what do you do at SAB? What is your role really comprised of today?
So SAB Capital is a commercial real estate investment sales firm. We're primarily focused on sale-leaseback and net lease, which is my area of focus and what we're going to be, what's going to be most relevant today. We've got a team internally that's focused exclusively on 1031 exchange representation. We can talk about that some. And then we've got some other arms within the company that are focused on affordable housing, Brooklyn area commercial properties, and a debt brokerage group as well. In 2023, we closed over $500 million in transactions. The clients in the industries that we work with on the sale-leaseback side of things are auto dealers, of course, other auto-related businesses like car washes and collision centers, gas and C stores, gyms, restaurants, childcare, manufacturing, medical offices, just to name a few. So, I mean, the sale-leaseback landscape is massive, but call it broadly, center-based businesses. Any business that operates to, provide a service or create a product that relies upon, a real estate footprint to grow their business. So,
What has driven the rise in dealership sale leasebacks? Before even that, let's just define what this even means. Like, can you give us the Spark Notes definition for anyone that is not familiar with the term? What is a sale leaseback? Because I want to talk about what has driven the rise of this in our industry, and then get into the economics.
sure, absolutely. So, sale leaseback is an alternative financing solution, and it functions as a debt and equity substitute for businesses, again, that I mentioned exist to make products and provide services. So mechanically, you're selling owned or controlled real estate, and you're maintaining operational control of that real estate by leasing it back from, an investor for a long period of time. So most typically it's, a 15 or 20-year lease, where you're with several tenant options to extend. So you've got control over this real estate for a period of, 40, 50 plus years in total. But, given that real estate ownership is not core to most businesses, particularly dealerships, right? Owning the real estate is not core to selling cars. It's a great tool that, extends a significant sum of capital. We'll get 100% to 150% plus LTV financing on real estate. And most typically that's without personal recourse, without covenants, and without taking on, a capital partner that's going to, dilute the operating entity. It's a massive market. It's a $30+ billion market.
I said there's been a boom in just sale leasebacks in industry. I've personally witnessed this. I've noticed a rise over the last couple of years. Why are dealers looking to sell their real estate as a form of financing nowadays? What has changed? Is it simply the fact that cap rates, that valuations went up, and so there's more liquidity potential, or is there other things I'm missing? Like, what has changed that has really enticed dealers to at least explore this form of financing if they want to grow or whatever?
Sure. I mean, one piece of it is, and I've heard so many people come onto your show and talk about the importance of scale and diversification within their dealership platform. And, so being out there and active in acquiring other dealerships as they come up for sale is of great importance to a lot of dealers out there. So that's a piece of it. And I think if you are tracking some of the data that some of these great, buy sell groups, I know you've had Haig on here a bunch of times, and Alan, listening to those episodes is great. He's very well.
Haig was just on last week, and he was on today.
So the last year, I think he had 400 plus buy sell transactions that occurred, and Q1 of this year is in excess of 150. So a lot of this M&A activity is important for fueling sale-leaseback transactions because of the nature of the access to capital. And as I mentioned, if we're talking, 100% plus LTV financing on the real estate, you're financing a massive portion of, the acquisition, and you can stay liquid and maintain the ability to recycle capital and continue growing via acquisitions or development, whatever comes
So
up.
it's safe to say that industry consolidation has been one of the big accelerants for sale leasebacks, as dealers are looking to scale more, and in addition to, I guess, retained earnings or other forms of financing, they're tapping into real estate to buy more dealerships, pretty much.
100%. Yeah.
Mm-hmm. Got it. So tell us more a little bit. I want to talk about the behind the scenes of dealership real estate, and then I want to talk about how you actually work with dealers and what really happens behind the scenes. Let's just start on the dealership side. What is a dealer nowadays paying on average rent or mortgage, like as a percentage of sales, right? Do you have any metrics that you can share with us like that?
As a percentage of sales, I mean, we're not typically tracking it that way, but I will say, like, if we're structuring a sale leaseback offering, for a client who's an auto dealer, the most important thing, and this is for everybody involved, it's for us, it's for the dealership, and it's for the real estate investor that is coming in and acquiring this real estate. They want to make sure that the business is going to be profitable. Everybody is incentivized by the dealership remaining profitable long term. One metric that we might look at is like a rent coverage, right? Which is we'll take earnings and how many times can you afford this rent figure with historical earnings? Assuming that the past is indicative of future performance. So, maybe and it depends based off of, what the pro forma is on a go forward basis for the dealership's financials. It depends on, the particular real estate investor, how comfortable they might be with a tighter rent coverage, or a higher rent figure relative to earnings. And, there's a lot of factors that go into it, but, most typically, we'll structure transactions that are in excess of 2.5 times rent coverage and as much as, 4 to 5 times coverage.
This episode is brought to you by OpenLane, the leading online dealer marketplace for used cars. OpenLane makes wholesale easy, bringing you exclusive inventory, simple transactions, and better outcomes, all with lower fees. Dealers never have to worry about finding the perfect vehicles for their lot, thanks to thousands of fresh vehicles each day, from the largest inventory of off-lease vehicles to rental, dealer trades, and more. OpenLane brings transparency to digital wholesaling with best-in-class inspections, exterior damage detection powered by AI, and simplified OBD2 code scan summaries. Plus, on OpenLane, you always know who you're buying from. And if you're looking to sell on OpenLane, you can turn vehicles into more cash fast. With a nationwide network of serious buyers, vehicles listed on OpenLane sell in less than a day on average. If you're new to OpenLane, you can sign up now and receive a $350 buy fee credit. Learn more at openlane.com or click the link in the show notes below. Are you targeting any specific regions of the country, any specific franchises? And more specifically, I would say, are there any specific areas that you're seeing more appreciation, right? Are we expecting that a Toyota store is like super safe and secure, and so you're just going to pay more for that? Like, give us a little bit more behind the scenes of kind of your thought process.
I'll break this out into geography, and I'll break this out into, brand, right? So like if you're looking at Toyota relative to Stellantis right now, dealers are going to be much more excited about an acquisition opportunity that, flies a Toyota flag than a Stellantis flag. Personally, I'm seeing a lot more, dealer acquisitions that are of Stellantis points rather than Toyota. And the Toyota ones are going to transact a lot quicker and at a greater blue sky multiple. But, when you look at that, right, if that multiple for the enterprise acquisition is greater, then it is less additive relatively for that dealer to execute a sale leaseback. That's not to say that it is not, impactful in financing the acquisition. But if you're paying 8 times blue sky for a Toyota dealership, and we're simultaneously executing on a sale leaseback for the real estate at, 13 to 15, 16 times, that delta is less significant. Whereas if this is a Stellantis dealership and you're able to acquire the enterprise at, maybe it's 3 to 4 times earnings, and we're executing on that same sale leaseback at, 12 to 15 times rent multiples, then it is financing a, that multiple arbitrage that exists is so much greater.
So you're saying that the dealers are benefiting more. The dealers are actually benefiting more from the, less sought after brands, because they're just simply getting a bigger spread on what they're paying versus what you would be paying. Is that correct?
Yeah. And I like Yossi, we should take a step back for a quick second and just say, like, at SAB, it's not our own balance sheet that we're buying this real estate off of, and we're not, acquiring it ourselves. It's we're acting in a brokerage capacity and acting as a fiduciary and an advisor to auto dealers that are executing on these transactions. So it wouldn't be us directly that are making these acquisitions, but I think if we look at it from the lens of, that multiple arbitrage again, I think it is significantly, that delta that exists between, 4x blue sky and 13, 14 times rent is greater than 8x versus the same rent multiple. And even if we take that down to a more compressed cap rate or a more significant rent multiple, that delta is still less significant for a Toyota brand. But if cost, it all depends on, what is most important to the dealer involved in the transaction. And that's the way we start off every conversation. It's like, hey, what is most important to you? Is it limiting cost of capital in this transaction? Is it limiting rent load over, the span of the lease? Is it, getting the greatest proceeds figure? What that's going to do is going to impact cost of capital more than anything else.
Do you find it tough to value these properties, right? Dealership real estate is so core to the operation. It's tied hand in hand. And the dealership to the real estate to the dealership. And clearly you're in the business of selling cars, the real estate is just bricks. But how big is that spread across different regions when it comes to the actual valuation of the real estate, right? I have to assume that you probably do some local benchmarking. But I would love to hear from you. Like, how do you go about that process, right? If a dealership property has been owned for 60 years, how are you now defining what it's worth for a sale-leaseback?
Yeah. So part of that process is, qualitative, and part of that process is quantitative. Quantitatively, we want to understand what market rent looks like in that particular geography. We want to understand what, the average cap rate of commercial properties transacted in that geography are. And we want to take that into consideration. And then the other piece of it, probably the most important piece of it, when you talk about just, purely, a proceeds figure in a valuation as a whole is, how profitable is the dealership? Because it is, one thing again that we always have to tie a valuation process back to is this rent affordable for the dealer? Is it affordable for them today? Is it affordable for them long term? Everybody involved in the transaction wants to see them succeed and be really profitable for a long period of time. So that's a big piece of the quantitative part of the analysis. And I can define this a little differently as we go, but the other piece is like qualitatively, right? Like, what brand is this dealership? Again, like we talked about the difference right now between in perception and performance between Toyota and Stellantis. That you're going to see wash out in cost of capital, represented as cap rate. So you're likely to see a more compressed cap rate in an apples to apples comparison. All else remains equal, you're likely to see a more compressed cap rate for a Toyota dealership relative to a Stellantis dealership.
So I'm going to put my dealer hat on and say, if I met you, I think the first question I'd be I've tried to figure out right away is, does this hurt my brand value, right? So if I sell my bricks today and then 5 years later I decide I want to sell the business, the enterprise, I'd have to imagine that you've, studied that or, look back at prior results or anything. Can you shed a little light on that side of the world and how selling the real estate impacts the dealership's value long term?
Well, I mean, if you look at, dealership buy sell transactions, right? You're buying goodwill and you're buying the real estate. Most typically, that's the most common, right? And real estate is obviously a significant portion of the total valuation or compensation in that transaction. So if you are selling the real estate in a sale-leaseback transaction today, you have the immediate access to that capital to be able to reinvest it into that business. Maybe it's growing in buying, another point nearby. Or maybe it's reinvesting that capital back into the business and seeing an improvement in performance in the short term, right? So then when you go and you're selling that, the enterprise later on, assuming there's improved performance there, the blue sky multiple on a greater figure is going to yield a greater proceeds figure. And just know that you've already cashed out into, so to speak, on the real estate, but you've benefited from reinvesting that into the business.
So you're basically saying that during a sale of the business, these two pieces are anyways segregated, the real estate and the business, which is true. And so it's sort of it's mutually exclusive opportunities. And this is just one way to take advantage of the real estate without selling your actual operating business.
Yeah. And one important piece of that, right, is that in that transaction where you tie the sale of the business to the sale of the real estate to the same acquiring business owner, you're most typically going to value the real estate at appraised value, right? And that appraised value is going to be tied to the utility value of that real estate for that dealer and some function of, local market comps for vacant and utility value real estate, right? But if you execute a sale-leaseback, when I say you're getting 100% plus LTV for that real estate, that might be as high as 150% LTV. That's of appraised value. So you're getting a greater proceeds payout from the real estate via sale-leaseback because now you're valuing it based off of the income stream from rent.
So now I want to put my accounting hat on. Talk to me about some of the tax consequences. That was always a big consideration for me. Obviously real estate tax is very, very efficient. How does this impact tax consequences? Give us some insight into that side of the world.
So I think first and foremost, in the downside of this, right, is that if you sell your real estate, you can no longer depreciate the structure, the improved structure on your land, right? On a positive note, for sale-leaseback, right? If you have a conventional commercial mortgage and you own your real estate, what is deductible there? It's the interest expense. Now, if you sell that real estate and lease it back, the entirety of your rent payment is now a deductible expense. Will depend on a case-by-case basis exactly where that washes out between that trade-off, but it's comparable.
Do you find that when dealers do this, like do the facilities go neglected? Or again, I'm maintenance when it's suddenly not you're smiling. I mean, what happens to the facilities? I'm sure there's clauses and whatnot, but how does this actually impact the experience from, improvements to the facility? Suddenly, the OEM comes and says, hey, you need to upgrade your facilities and invest $1 million. Like, how does all that work once you sell the real estate?
99% of the time these days, a sale-leaseback is executed with an absolute triple net lease. So the dealership owner, whereas when you own the real estate, you're paying taxes, you're paying, for maintenance and repairs to the property, you're paying property insurance. With an absolute triple net lease, the dealership continues to maintain those responsibilities, and it's truly passive income for the real estate investor, the sale-leaseback provider in the transaction. And that's the way to, that we're structuring transactions that yield the cheapest cost of capital, right? I mean, you pay for the convenience of not being required to manage that property.
This episode is brought to you by Cars Commerce, the platform to simplify everything about buying and selling cars, including the quote-unquote follow-up. Let me explain. Dealers, fast and effective follow-up is crucial for converting leads into customers. But here's the problem. 40% of shoppers report that they are not getting timely or helpful responses from dealerships. This is a huge problem because your own team could be leaving 4 out of every 10 sales opportunities on the table. Cars Commerce makes it simple to measure and improve your follow-up performance. A Cars.com experience report tracks the percentage of leads your team is responding to and how customers rate those responses. While Dealer Inspire's retailing technology enables your team to quickly text follow-ups with personalized financing options to make the most out of every opportunity. To learn more about how you can measure and improve your team's follow-up performance, go to carscommerce.inc/experience or click the link in the show notes below.
So tell us, like, what regions are popping right now? I mean, where are we seeing where are we seeing good action? What's interesting? Like, tell us, if I was a fly on the wall right now in SAB Capital and you had your weekly meeting, right? What's top of mind?
The franchises that we're working with most commonly are, as I mentioned, Stellantis, Ford, Chevy. It seems as though a lot of the dealers that we work with are bringing us acquisition opportunities with those franchises. They're able to buy them at cheap multiples, and that arbitrage that exists in a sale-leaseback transaction is most evident. So those are probably some of the most popular franchises I work with. Geographically, again, given that there is some trade-off between what's affordable for the dealer and valuation relative to appraised value to create this growth capital. Sometimes in the secondary and tertiary markets where the appraised value is going to be less, if we've got a profitable dealership, that growth capital generated in the transaction may be greater in some of these secondary and tertiary markets. And there's less pride of ownership for some of those dealers for the most part in owning their real estate. Like if you've got trophy real estate in a fantastic market, like owning that is a whole lot more appealing for the dealer than a market where finding land is easier to come by.
Where it's not as exclusive or unique.
Yeah.
All right. So, Mark, you mentioned earlier that you are not the actual buyer here. Makes sense. You're an advisor. But who are these buyers typically? Like, who's looking for this type of income? And how do you help them value the dealerships?
The buyers for these assets are, they're REITs, both public and private REITs, real estate private equity funds. You've got 1031 exchange capital, which are typically private investors that are leveraging the IRS code 1031 to execute a like-kind exchange and defer taxes by selling a property and then buying a replacement property. And then you've got private family offices that are well capitalized and groups of that nature as well. And how are these assets being valued? Like I think it comes down to three main components, which is credit, lease, and geography. So, again, like if we isolate each of these three categories, then let's assume all else is equal within the transaction, right? You're going to, pay a premium for a dealer with a credit profile of, 20 million in net earnings than you are a dealership that, has 1 point and, they're clearing $1 million a year because, they're going to be, better capitalized to be able to afford rent long term. The probability of you receiving those rent payments for a long period of time is going to be greater. So credit is an important factor. How many rooftops they operate? What does each particular dealership involved in the transaction look like? What is the four-wall performance of the dealership and how is rent established relative to that? The next point is lease. If you've got a strong operator, and again, everybody involved in the transaction wants the dealership to succeed long term. You want a long-term lease with an entirely passive lease, such that you're just cash flowing on the investment as the sale-leaseback provider. And then the last component of valuation is geography. And again, each of these 3 points is going to be most evident and reflected in the cap rate of the transaction. So again, that is your cost of capital as the dealer executing this sale-leaseback. So that's pretty simple. So it's real estate at the end of the day. So much of it is a finance tool that's backed by a credit that's tied to a lease. But what does that particular submarket look like? Is this a primary dense infill market, or is this a tertiary geography with 10, 20,000 people within a radius of the store? right? And that's going to differ greatly. But the last piece of geography too is, what's a safer investment? This is, like, I'd be curious what your opinion on this is, right? You'll see, like, would you rather buy a real estate investment property, right, where you were getting $15 a foot in rent from your tenant, but market is $20 a foot, right? But it's a market that you're unfamiliar with and has, low population density? Or would you rather make the investment into a property that was, in a really core dense infill market where, rent on average was $35 a foot, but your tenant is paying $50 a foot? Like, what would be a safer investment for you? And that, like, it totally depends on some of these other factors, right? But I just want to, I want the point to come across that, that's where geography beyond, hey, how desirable is, this one market relative to the other, but like what's actually going on within that submarket, and why are elements like market rent per square foot important to determining valuation?
Yeah, I think it depends on the profile of the investor. I mean, I think it's good for the dealer. Obviously, if they're in a better location, better geography, clearly. So they're just going to get better premium on their property. Tell me a little bit more about your outlook for the commercial real estate market and specifically dealerships. Look, we know that profitability is declining. We're still way above 2019 levels. That's great. But profitability is declining now. Investors aren't dumb. They know profitability is declining. You know that. So like, what is happening right now to valuations on real estate? How are you getting deals done? When someone, when people see kind of the state of the market, how are you actually able to get deals across the table?
One of the most important trends, it's so frequently talked about in our industry, right? And that's, the cost of capital for real estate investors financing their acquisitions. Everybody's got a cost of capital that ties into benchmark rates somewhere, right? So a lot of time and effort spent on tracking Fed decisions with regards to rate cuts that are upcoming. I think in a month's time, we're headed towards a minimum 25 basis point rate reduction. If we see unemployment figures that are, even modestly greater than the July release, then there is an increasing possibility that we're headed towards a 50 basis point rate reduction. If we head towards a rate cuts in a lower interest rate environment, that should benefit the entire commercial real estate market. I don't think we see that immediately in cap rate compression, but we will see an uptick in transaction velocity in the market as a whole.
Mark Pomella, any closing thoughts?
There are a lot of intricacies to the sale-leaseback process that, it's hard to cover everything in such a short period of time in this podcast. And I feel like it's flown by. But I just want to note that, we're always happy to talk and share our insight on what's going on in the market and some factors that auto dealers can be mindful of in preparing in leveraging their real estate portfolio.
No, definitely appreciate that. And we'll put the link in the show notes below. So if anyone wants to get in touch with you or SAB, we'll put the link in the show notes below. This has been super insightful. Mark, thanks for coming on.
Thanks, EOC. Absolute pleasure.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.